manager on the Aberdeen Diversified Income and Growth Trust. Thank you for your time this evening. I appreciate the opportunity to talk to you about ADIG. ADIG is a multi-asset investment trust. It has a NAV of over 350 million. Target return is 6% per annum over a 5-year basis. We have a low gearing at present, and it's currently priced at a 6.2% annual dividend yield, which is paid quarterly. I'm going to tell you two things this evening. I'm going to tell you that ADIG is diversified, and I'm going to demonstrate how this has helped our performance. And I'm going to tell you about our private market holdings, what we mean by private markets, and why it's a good thing that we're invested there. Sorry, trying to move on. There we go. So what was the recent market landscape? A good way to describe it and the way we think about it, it was like driving on an icy road. You needed caution at every turn. From COVID to Russia to inflation, 49-day prime ministers, there have been many icy patches, and care was needed just not to slip off the road. So how did we negotiate this environment? Actually, relatively well. So in 2021, ADIG had a 15% return, while last year we returned minus 0.7%. That's normally not something to be super proud of, but 2022 was an okay result in context. And you can see on the chart there, the ADIG share price in blue and our NAV return in orange. And I've also outlined some of the icy patches in that chart, the pandemic, Russia, inflation crisis, and then the UK gilt and LDI crisis. And in fact, focusing on the gilt and LDI crisis, you can see that our NAV, which is the orange line there, was actually much less impacted compared to the share price sell-off. So the portfolio was robust despite the market conditions, and a 14% return over the last 2 years, so slightly above our target. And how was this achieved? Through diversification, and particularly the diversification benefits of private markets. At a high level, ADIG is allocated across equities, fixed income, and credits, and private markets. And you can see that there were some winners and some losers last year. So listed equities was a drag on performance, delivering minus 3.4%. Fixed income and credit, also a slight negative drag on performance, but the positive performance from the private markets investments. And that's the point of diversification, to have the different investments providing different returns from different sources. You don't want everything going down in the same direction at the same time. And you can see also on this slide the broad allocation that we have at the moment as well. So listed equities forms 20% of the trust, fixed income and credit is 20% of the trust, and private markets is just over half of the trust exposure. So that's the high level picture as to where we are currently allocated. And here is a slightly more granular picture, and you can see where we made money last year and where we didn't make money last year. You can see the negative returns there from equities, in particular the UK mid-cap and global equity positions, which are the two large red blocks there. But you can also see the positives from the private markets exposure, particularly the infrastructure block, so the large green block there as well. And sitting at the start of 2022, our concern was Omicron and its impact. And while Russian troop activity was noted, I don't think it was in anyone's base case that an invasion was imminent. So while we have a view, we need to be prepared if that is wrong, and we need to have a portfolio that's prepared for that view to be wrong as well. And that's what a diversified portfolio will do. In 2022, rising inflation and the central bank's speed of rate rises in response to this rising inflation was unprecedented. Did the rate rises impact financial markets? Yes. Did the UK property index have the worst 2 months ever in October and November? Yes. And did this impact ADIG? Yes. As you can see, it was our third worst performing asset class. However, the flip side of that is, did we have investments that would benefit from high inflation? Yes. So infrastructure on both the listed and private side was a large positive contributor last year, where revenues have inflation linkage or are linked to power prices directly. So clearly a good source of returns last year. So with a diversified portfolio, including our private market exposure, we managed to protect investors' capital in a difficult year. But that's the past. What about the future? Again, we don't have a crystal ball, but coming back to our icy road metaphor, there are some potential skid risks ahead, but also some clear roads too. The first risk is on the market perception of the outlook. Everything's looking quite rosy at the moment. Rates are cresting soon, inflation's coming down, albeit slowly. But if that view changes, risk is likely to be on the downside rather than the upside. However, were we to see expectations shift negatively, a Fed pause could lead to a rally in risk assets, whether that pause is real or imagined. But ultimately, if inflation remains sticky and the Fed go too far and kill the cycle, this could cause a recession and a loss of earnings. But in that scenario, even in that scenario, China opening up again will help offset this weakness and boost emerging markets as they emerge from their net zero policy. So there's lots of uncertainty at present, and we need to be building a portfolio that is placed to benefit from the upside, but also has some protection on the downside. And with that in mind, where are we positioned today? I'll talk through the public market first. So the purple in the top right of the chart is equities. And within this, you'll note we don't have your traditional equities. We have some listed infrastructure trusts where we see inflation linkage. We have some listed royalty vehicles as well, where earnings are less correlated to market cycles. We have some REITs, as well as some global equity positions, which are positioned for rebound and growth scenarios. The green is fixed income, and you can see here that we have mostly floating rate exposure, with ABS to protect from rates rising further, and some EM exposure, which is linked back to that China reopening benefit that I mentioned just now. But crucially, and I think the USP for ADIG is the private markets, which is this pink section on the left-hand side, so over half the trust. I've alluded to it a bit, but what do I actually mean by that, and why is it useful? So Aberdeen is one of the largest private market managers globally and has over 73 billion of investments. So we have a lot of people around the world who are very good at selecting and investing in markets, in the private markets around the world. The one thing I would like to also point out is that private markets is not just private equity. We also invest across private credit, real estate, infrastructure, and natural resources. And within ADIG, infrastructure is our biggest exposure in the private markets, with private equity at second at only 10% of the total funds. And within infrastructure, just to pull out a few of the assets that we have in our portfolio, we have the largest portfolio of operating solar assets in Poland. We have a fleet of new trains being built and will be leased to an operator on the West Coast Line here in the UK. And we have a new port terminal, which is being constructed in Colombia in South America for super large vessels, so post-Panama Canal vessels. In many of these cases, there is inflation linkage, and the counterparty is the government of that country, be it UK, Colombia, or some of the Australian assets we have under PPP schemes. For real estate, we have several assets, but just to pull one out, we have a fund in Europe, which is turning offices into modern residential blocks. In a post-COVID world, what we need is less office space, and the higher alternate use for these is as residential properties. So we have a fund executing that strategy at present. You'll also note that we have some royalty exposure, and this is healthcare royalties, where we receive income based on the sales of treatments in the US for fairly routine conditions like gout and macular edema, which is linked to sight. And cases of these are clearly not very closely linked to the market cycle. So uneconomically linked sales is good for us, and we get a nice steady yield from this investment. We can also say the same about litigation finance. It's not closely linked to the economic cycle. We're funding court cases here, mostly in the US, and we will receive a stake in the proceeds. So there are clear benefits to investing in the private markets for us. There are some growth opportunities, and there are some less economically linked investments, and there are some income opportunities as well. And there's also some inflation linkage. And I appreciate that there'd be concerns about private markets, about liquidity in particular. However, we are a closed-ended trust. It's the right structure for liquid holdings. There are no gating or redemption suspension mechanisms when investors want to sell. And just to bring the portfolio to life a little bit more, I'd like to talk about one of the assets, or one or two of the assets in particular. And the first one I'd like to talk about is the I-77 asset, which was 4% of ADIG, and we exited it in Q4. So in December last year, we sold this investment. And what it was express lanes on the I-77 highway, which goes to and from the city of Charlotte in North Carolina. So we part-funded, alongside other investors, the construction and operation of these new lanes, which collect and charge fees using automatic number plate recognition, so not the traditional toll gate system. And interestingly, the toll lanes are obliged to ensure a minimum average speed of 48 miles per hour or more, and it achieves this using dynamic pricing, so changing the price every few minutes. So if traffic increases, you put up the price to deter people from using it and make sure that the traffic keeps moving through at 48 miles an hour for those who are willing to pay the new price. And it's segmented so people can turn off and on as desired, or return to the normal lanes if they'd like to. So what we saw with this investment was traffic levels recovered during COVID lockdowns and was in line with forecasts. But what was found earlier last year was that people were willing to pay more than expected to ensure that they missed the traffic and got through in 48 miles an hour. And that increased revenue, meant that we were able to mark the asset up significantly, and it's performed very well for us over the year, as you can see on the chart there. Since construction was complete and we sold last year, we got back 3.5 times the money we invested within 5 years, and we'll use this to reinvest in new opportunities. I'd also like to talk very briefly about one of the other assets we have in the fund, which is on the private equity side, and that is to Sticks and Sushi, which is a restaurant chain in Denmark, London, and Berlin. So you may have seen one or two of their branches around. It serves Japanese-style food with a focus on freshness and quality. There's a good record of opening in new locations, has a good management team that were nimble during COVID and during lockdowns, expanding the takeaway service and continuing this post-lockdown as a new revenue stream. Performed very well, and there's lots of potential to expand. So while this investment is a private equity investment, it's in the growth space. It's not in the, the asset stripping or financial wizardry territory. It's a company that will likely be sold to a larger restaurant group or will IPO further down the line. So that's a couple of examples there of where we are invested in the private markets. We do have some further case studies on our website. So my final slide before I hand over for questions is, where will we be at the end of this year? The answer is that we don't know for certain, but we know that uphill slogs have to end at some point, and the key is to make sure that you are protected and that you keep moving forwards. I'll wrap up there to leave time for questions, but I hope that I've shown that the Aberdeen Diversified Income and Growth Trust is well diversified, and that this diversification was beneficial to us over a volatile period over the last few years, and that the private markets exposure we have is more than just private equity, and that we have seen a positive impact from investing in private markets.
Thank you very much indeed. That was very interesting. That toll road makes you worried, doesn't it? what might be coming our way? But they're very interesting what you described around the difference between private equity and what people might think about private equity and what the trust does. And most of our questions are around your private holdings. But before we get on to that, the first one we've had was about discount control. Do you attempt to control the discount of the trust, and if so, how?
Yes, we do. That's a policy that's been developed by the board, and we work in conjunction with them on that. We do that via share buybacks, and you'll have seen that we have been buying back shares in the market recently.
What's the current discount at the moment, Nick?
The current discount is 24%, I believe.
And next up is about private equity valuation. So, and how frequently is the NAV measured, and how are the private, or all the private portions of the portfolio valued?
Yeah, no, that's a good question and a very fair question. The assets are valued quarterly, but within this, we do review assets on an ongoing basis, and we do make fair value adjustments if we believe that the investments that we have are marked at a value which is no longer reflective of fair value. So we do have examples in the portfolio of investments where we have marked the value down from the capital statement which we got from the manager, because we believe that the fair value of it is intrinsically lower than what they have said, and that was due to discount rates they were using to value the investments. We thought it was slightly too aggressive, so we recalculated the value based on a slightly more appropriate discount rate. But in general, sorry, go ahead.
Sorry, no, to interrupt you. No, please. I'll ask afterwards. Sorry.
I was going to say, in general, so we do review valuations across the portfolio, and we do ensure that they are appropriate across private equity, infrastructure, and real estate.
Next question again is about the private aspect. This came in as an email before we had the webinar this evening, so I was going to read it off the sheet here. It says, an article in the newspaper said that Aberdeen is in discussions with Santander to sell its private assets. If that happens, will or how and if will this affect the trust?
Yeah, well, firstly, I can't obviously comment on press speculation. It's not something I can really have an opinion on at the moment, so I apologise about that.
Next question then, listed royalties, part of the portfolio. I think royalties and royalty investing isn't something that maybe many of our audience are hugely familiar with. I think I'm heard it mostly with natural resources in Canada and North America. Can you talk through what royalties exposure you have in the listed side and what it is as an asset class?
Yeah, so the royalties we have in the portfolio are music royalties, where the manager has bought the rights to income in the future from music stars. There's been a few sort of cases in the news where you've seen that come through, and then what happens is we then take over the earnings and the royalties that music would earn by being played on streaming platforms or through being used in films or TV. So a lot of musicians are looking to cash in now and sort of earn that, bring that money forward to basically have it today, but we will get the future income from that. We also have some healthcare royalties as well. So biopharma credit is a holding of ours, and again that's linked to the sale of treatments, medical treatments in the private side as well. We have in the US healthcare royalty programs where you get paid a certain amount of income for if sales of a certain product hit a certain level, similar to that in the music royalty space. It's from people who want to have money now to fund further research, and they give up future income, which we then earn in lieu.
Next question was about the private infrastructure, and I think you described the toll road. Can you give some other examples of kind of assets that you own?
Absolutely, yeah. So we have several assets on the infrastructure side. As I mentioned, we have the largest solar portfolio in Poland, and we have some district heating assets in Finland. So that's regulated assets, sort of networks providing heat to buildings in Finland, using sort of elements of biofuels there as well. We have some a lease to in Mexico on a low sulfur refinery to Pemex, so broadly linked to the Mexican state, and that it may seem strange, in a sort of a low emission world to sort of lease out own and lease a low sulfur oil refinery. However, this is a key part of the transition to a lower emission world by refining lower sulfur fuels, so an important part there. But we do have lots of assets, and there are some more case studies on our website as well, which should hopefully bring the portfolio to life.
And I hope you don't mind me being a little bit challenging, Nick. I had a couple of people ask about the capital performance of the trust over the last 5 years, and not being as strong as investors might have hoped. Can you comment on that, or your strategies to increase confidence about your ability to grow the capital?
Yeah, no, absolutely. I think it's a very fair comment. So the strategy of the fund was reviewed a couple of years ago, and the decision was made to tilt more towards the private markets team, the private market solutions team, which I'm part of, and hence why we've seen the private markets exposure increase to now to the 52%. So that is going to be our source of future growth. There have been some historic investments which did not pan out as expected, but these are all very low value in the portfolio now, if not written off completely. So the path now is to concentrate on the private markets and the benefit that that brings, and grow capital and distribute income in that way.
And a question about the what you invest in, I guess. And the question is asking, do you invest in other funds? Is most of exposure through other funds? Is ADIG a fund of funds or a mixture?
It's a mix. It's a mixture. So in the private market space, we make investments in primary funds. So we will invest with other managers, both internally and externally, who then go out and build a portfolio of 6 to 10 assets or whatever it may be. So we do that on the private space. On the listed side of things, we have separate sleeves, which are managed by the active managers here. So that EM bond exposure we have is through a bond sleeve, which is managed internally by our EM bonds team. Similar story to the global equity exposure that we have as well. That's a sleeve which is managed just for ADIG by an internal party. We do buy some external listed trusts, but it's not the main part of our strategy. It's on an opportunistic basis to see when we see opportunities.
I think might be my final one. It's a question about kind of correlation to the markets. You mentioned a couple of your investments are attempting to be uncorrelated, royalties in particular you highlighted. Overall, can you give a sense to how correlated or what percentage of the whole portfolio you feel is less correlated to equity markets?
Yep, no, it's a good question. I think we do have a sort of uncorrelated income. We expect that to be about 22% of the portfolio in purely uncorrelated income. However, we will see diversification benefits from the real estate holdings following quite idiosyncratic strategies, and they won't rise and fall in the same way that sort of listed REITs will as well. So while 22% is kind of uncorrelated on that basis, there will also be diversification benefits as well from the holdings. So I'd say it was slightly higher than that as well.
Okay, thank you very much. I think it's a really interesting underlying portfolio and exposure there. So thank you very much for explaining and talking through the trust.
No, that's great. And thank you all for your time this evening.